Now, this chapter you will hardly find any material in one place. Suppose even if I want, when I studied, I had to buy 7 or 8 books of different authors to study bond market. It's a very vast ocean. If you like this chapter at the end of the course, then I would suggest that you must go to UK or US and do a dedicated course on bond market. Lot of university courses are available for 1 year, and your bank gives a loan for that. And suppose CA and you do bond market, definitely you can't come back to Guntur for work. You will have to work elsewhere, and it has got a good scope. Now when India is expanding, economy is growing, we are going to be the fastest growing economy in this year 2023. Yes, Vietnam is a very small country. Other countries are there, Taiwan maybe, but the percentage, they are very small country. I am talking of a large country. So as the years progress, so many companies will have a dedicated treasury desk where they will require a professional to manage issue of debt, manage IPO, manage securities issue. So going to be a very, very demanding job. So you must get that qualification where you edge your competitors. If you like this chapter, then do. Suppose many of them don't like bond market. I myself did not work in the bond market. I worked in equity market. See, I am teaching, but my liking was elsewhere. But it's a very interesting chapter. And the amount of money, if you read ET, the fund managers of big mutual funds, they manage 75,000 crore, 80,000 crore, 1 lakh crore, and with the size of the debt market expanding in India, and I am telling you, it will give a totally different pleasure, happiness to manage portfolio of that size. Even in equity, you can't dream. Okay. Anyway, let us start from scratch. Let us understand what is a bond and how different it is from a debenture. So you all know what is a debenture. It is a security issued by company to raise debt capital. Usually, debentures are secured by assets of the company. So we can say that they are safe investment, much safer than equity. Later on, as we progress, we will see debentures are also very risky. Now, debentures pay regular interest year on year. They return the face value at maturity, and most of them are having a particular term, 6 years, 7 years, 5 years, etc. In all this respect, bond also has the same feature. Usually, when corporates issue debt paper, we call it debenture. And when institutions, government, they issue, we call it as a bond. We never say Reliance issued a bond. We say Reliance issued a debenture. Now we can say that government company, let us call a bank also, we can use, let us say government company NTPC. They issued a bond. So government companies, they issue debt paper, we give us separate name so that they are identified in the market. So otherwise I can call everything as debenture. Second difference is, debenture you pay stamp at the time of issue as well as transfer. in debenture. Whereas in bond, you pay stamp duty only at the time of issue. So government bonds are what we call, if NTPC is issuing a bond, you generally pay stamp duty only at the time of issue. For transfers, you don't. Then the revenue collected from the stamp, in the case of company, goes to state government, where the head of a registered office of the company is located. Whereas revenue collected in the case of bond goes to central government. So these are only very, they will not ask you, I'm just giving you what is the difference between a bond and a debenture. As far as pricing formula is concerned, and as far as risk is concerned, we are going to treat both alike. So in the exam, you may get debenture also, you may get bond also. Our formula is going to be same. In the case of debenture, the annual payment made by the company is called interest. In the case of bond, we call it as coupons. So we use the word coupons. Okay. Another change could be like in India, government bonds or government security pay coupons twice a year, which is the case in most countries. But government of France or Germany, they issue bond, they pay coupons only once a year. So these differences are not going to be asked, but general knowledge, I told you, you must read ET. Now as I am completing chapter after chapter, you will find that lot of things in ET you already know, you start knowing. So for example, this bond, what I am telling, you would see when you read the news, you come to the bond, something is written, let me read. So whatever we have dealt in the class, so whatever we learned in the CA final level is sufficient to understand what is coming in the paper, and you must do it. So coming back to bond. So this about, you won't write this bond debenture difference? You won't write down 3 points. This they won't ask in the exam, don't blame me otherwise. I told you not to throw the notebook after you pass. Keep it, it will be extremely useful even if you are not going for a finance, because as we cover chapter after chapter, we are going to write so many things. I will make you write in red, which is coming from the practical world, which institute material will not give any time. Write down. Debentures are, so this I should tell you that this is in section 2, and we get 8 to 12 marks. So if you are going to do section 2, then you are going to do this chapter. Now, debentures are debt papers or debt securities. Debentures are debt securities issued by companies. Debentures are debt securities issued by company usually against the security of assets. Usually against the security of assets. Bonds are debt securities of financial institutions. Bonds are debt securities of financial institutions slash government or government owned companies slash government owned companies. Next point. Regular payment on debentures are called interest. Regular payment on debentures are called interest, whereas on bonds, comma, called as coupons, called as coupons. Next point, stamp duty is payable on issue and transfer. Stamp duty is payable on issue and transfer. In the case of debentures, whereas it is payable only at the time of issue, whereas it is payable only at the time of issue in the case of bonds. Next point, revenue from stamp collection, stamp duty collection, revenue from stamp duty collection goes to the state government. Revenue from stamp duty collection goes to the state government, where the registered office of the company issuing debenture, where the registered office of the company issuing debenture is located. Full stop. However, in the case of bonds, it goes to central government. However, in the case of bonds, it goes to central government. Now, let us understand how different is a bond from equity share. Whatever we have learned, I'm not going to talk about the risk and all. Bonds, so equity share give me inflow, dividend. Bond also gives me inflow, coupons. But we have learned that we are not going to sell back equity share, so that PN is not there. When we valued, please understand one more thing. In valuation, there is a very important principle that you must take all inflows till infinity. You cannot think that one company, it will run only for 24 years. So I will take only 24 cash flows. That doesn't exist in valuation. We are going to take inflows till infinity. But in the case of bond, it is not till infinity. We have a specified term. So we take cash flows only up to a particular term, 5 year, 10 year, 15 year, whatever it is. Now, when the company is coming out to the issue, so usually let us first see what are all the parameters in a bond. Coupons, we call it C. Term to maturity, we call N. We use this. Then face value, we call it as BN. Expected rate of return, we call it as K. And finally, bond price today, we call it as B0. So these are the 5 parameters in the valuation of a bond. Serial number 1, 2, 3 will be decided by the issuer, and once issued, these 3 will not change. Suppose a company is coming out with 7% 10-year bond. So 7% will not change, 10-year maturity will not change, face value will not change. Once it comes in the market, these 3 will not change. But as the market rate swings, K changes, and when K changes, B0 changes. So 3, 4 and 5 are decided by the investors in the market. 1, 2, 3 are decided by the issuer in the market. Now, as far as valuation is concerned, same principle. Price of a share is nothing but future dividend discounted. Price of a bond is nothing but future coupon and cash flow discounted or face value discounted. So if I write the price, B0 equal to coupon doesn't change, 1 plus K, 1 plus K square, C plus Bn upon 1 plus K raised to N. So we have got C, K, Bn, N and B0. So the 5 parameters are there in the bond price formula. Formula is similar to our share price formula, yes or no? What is one change? Bn. Bn, instead of Pn we call Bn. Instead of P0 we call B0 for bond. Now I told you that C, Bn and N doesn't change. The issuer, once he announces, it will be freezed or frozen, will not change. But K and B0 will keep changing. What is K? I have an expected rate of return. Suppose market rate is 10%. Now she cannot demand, I will buy this bond only when it is 20%. She cannot demand. We have to understand, we are assuming rationality of investor. Whatever is the return demanded for a security, we accept, assume that investors demand that return only. We will see as we go along. Okay. So we will write the remark about this. Write down next. Parameters in a bond. Give the heading. Parameters in a bond. The five parameters that is used to value a bond, the 5 parameters that is used to value a bond are just copy these 5 parameters. Of the above, the first three parameters of the above, the first three parameters are decided by the issuer. The first three parameters are decided by the issuer and do not change after issue of the bond. And do not change after issue of the bond. Once the bond is issued, K changes with the market rate. K changes with the market rate and therefore impacts B0. And therefore impacts B0. Next line, basic formula of bond price. Give the heading basic formula of bond price. Copy the formula. Okay. Now, what we will do, we will study how the parameters impact bond price. For that, we must know how to write this in a different form. You have learnt in IPCC, possibly in time value of money, I don't know where you have learned, to write in present value factor, using present value factor, C into PVIF A K comma N plus Bn into PVIF K comma N. Now C is available every year, so annually. C is available annually, therefore I use annuity factor for C, because you can see C is there everywhere till the last year. Whereas Bn is available only in the last year, therefore we don't have PVIF A, we have only PVIF. Second point is the discounting factor is K, because we are discounting throughout with K, and we are discounting for n years, so therefore we have n year, and this is discounting in the nth year, therefore this is n. You understood this formula? Write down. The above formula can also be written as, now this is what you will write in the exam everywhere. You will not be able to write the fraction every time. The above formula can be written as V0 is equal to, the above formula can be written as V0 is equal to C into PVIF A within bracket K comma N plus Bn into PVIF within bracket K comma N. Now let us calculate the first bond price. Example, write example. Calculate the price of bond A. Calculate the price of bond A which has a face value of 1000, which has a face value of 1000, paying coupon of 10%, paying coupon of 10%, and a maturity of 5 years, and a maturity of 5 years. Assume expected rate of return equal to 10%. Assume expected rate of return equal to 5%. Oh, sorry, 10%, 10%, sorry, 10%. Now take page number 530, 535 and 537. 535 and 537. So tell me what you are seeing. Let us write first for bond A. What is C? 10% of 1000. What is 1000? Face value. Face value equal to 100. What is N equal to? 5 years. What is BN? 1000. What is K? 10%. Therefore, B0 equal to 100 into PVIF A, 10% comma 5 plus 1000 into PVIF 10% comma 5. Correct? So see the table and tell me what value you are finding. First one is 3.791. Zero 0.621. If you add, you get 1000. What is the other way of calculating this? What is the other way of calculating without the table? Table will not be given in the exam. 1 divided by 1.1 equal to m plus equal to m plus equal to m plus equal to m plus equal to, so whatever value you are seeing, that will be 0.621. So you write, then m plus, then if you do memory recall, it will be 3.791. Better try, because this is the beginning. You will be calculating at least 90 to 100 bond prices in the chapter. So just verify whether you are getting the same thing. You will be getting, but see whether you are able to do it. and that rejected calculator will give wrong answer. How many are having rejected calculator till now? Rejected. They will not tell also, because they are going to be affected now, seriously. All are getting 1000. Okay. Next example. Next example. Calculate price of bond B. Calculate price of bond B with coupon equal to 10%, C equal to 10%, N equal to 5 years. Calculate price of bond B. Coupon, I thought you will write C. Okay, no problem. C equal to 10%, N equal to 5 years, Bn equal to 1000, K equal to 8%. One zero. Now for the next bond, you will not use the PV table, you will use the calculator. Ready? First you write the question. Example 3. See, example 1, 2, 3, they are interlinked. We will merge them later on. So calculate example 3. Calculate price of bond C. Calculate price of bond C where coupon equal to 10%, N equal to 5 years, Bn equal to 1000 and K equal to 12%. And K equal to 12%. Nine 927.5. Take your time, verify the answer. You must be familiar with both. What institute does, in some question they give the PV table directly. In some question they don't give. So they expect the student to calculate. So here student what they do? They use the entire decimal. They ignore the message given, use only 3 decimal. So you should be familiar with both. Can we proceed? Okay. Don't write now. I'll explain first and then we'll write. So this is what we got. Correct? And in all the case, C was 10%. Now simultaneously we will also see this particular equation. So we can make a lot of inference from this particular calculations. Number one, you can see that K is here in the denominator. When K increases, B0 decreases. When K decreases, B0 increases. The most fundamental bond, we can say property. Price and yield are inversely proportional. It is also in equity, but widely used in bond. In equity also, when K increases, P0 will decrease. But we have changing inflows in the numerator. Here inflows do not change. So all the concentration is on K and B0. So first property is price and yield are inversely proportional. If yield rises, price falls and vice versa. Second property. Now when the bond pays a coupon of 10 and the expected rate of return is also 10, then the bond trades at par. The price of the bond is equal to Bn. So when bond is issued at 10%, issuer is telling take 10% I will give you. I am an investor. I am expecting 10%, same as what the issuer is giving. Then I will be willing to buy the bond at par. Means whatever value is issuing, I will say okay, you are giving me 10%, you are issuing at 1000 rupees. I am also expecting 10%, therefore I don't mind paying 1000 rupees. It is reflected in the answer. So when K is equal to C, bond trades at par, and it is a crime to calculate in the exam. Whenever K equal to C, you should not calculate straight away, right? B0 equal to Bn equal to 1000. We calculated the first and only time we will commit the crime. Later on we will not. We have to understand, therefore we calculated. So in the exam also, institute doesn't expect, they may give sometime indirectly like this. Bond is trading at par. They will give C. Indirectly they will give K. They will give C and they will say bond is trading at par. So indirectly they will give K, because only when K equal to C, bond will trade at par. We can think from the mathematical part. Numerator 10%, discounted at 10%. So if we do that, we get the par value. So C numerator 10%, K denominator 10%. We will get 1000. Now, when the expected rate of return increases, so K is rising, C is there only 10%. So 10 is a smaller number, K is a bigger number in the denominator. You are getting an answer less than 1000. You are getting an answer less than 1000. So such bonds trade at discount. Now it is like this. Issuer is telling, I will give you coupon 10%. You are investor. You are telling, I want 12%. I want 12%. You want 1000. I will not give you 1000 because you are not giving my return. My return expectation is 12. You are giving me only 10% coupon. So I will not pay 1000. I will pay less than 1000. Therefore, bonds where expected rate of return is greater than C, they trade at discount. So therefore, in an economy where the rate of interest are rising, bond prices keep falling. So now we are going through that economy. In fact, last 9 months, K has been rising. Why? RBI is increasing rate. All the central banks of the world, they are increasing rate. So K market rate increases, investor expected rate of return increases. So when K rises, B0 will fall. First property, K is in denominator. Theoretically, mathematically, we know B0 will fall. So when K rises, B0 falls. When expected rate of return of investor increases, then it doesn't compensate for whatever investors desire. Therefore, they are not willing to pay even the par value. Therefore, they say we will buy your bond at discount. Therefore, we got the answer 927.5, less than 1000. Let us see the other extreme. Bond is giving 10%. Bond is giving 10% and my expectation is only 8%. Issuer is telling I will give you 10% and the current rate in the market may be 8%, but I will give you 10%. Good. I am getting more than what I want. Take premium. Take more than face value. So whenever K is more than C, remember C who is giving? Issuer is giving. K who is demanding? Investor is demanding. So when he demands less than what the bond is giving, then he say, well, I will pay premium. Therefore, we got the answer 1080.30. See the formula, K down, C up. So numerator weight is heavy. Numerator has more weight, denominator has low weight. Obviously, this will be greater than Bn. So this is equal to Bn. This will be less than Bn. This will be greater than Bn. That is called premium. So to make it very simple, I tell my students about, those days we used to buy, nowadays we have any number of channel. We used to buy, those days the fashion was to buy maximum number of channels in TV. So when you go to shop, we used to get 40 channel television, 80 channel television, 100 channel television. Mean that we can see only 100 channels. So assume that I had a budget of 10,000 rupees and I wanted to buy 100 channel television. I went to the shop. Sir, what is the TV? Sir, this 100 channel television. What is the cost? 10,000. Oh, it meets my budget. Take 10,000, I get it. So whatever I ask, he is giving. I pay whatever he wants. Second, I go to another shop. Sir, I want 100 channel television. Sorry, sir, we have only 80 channel television. So he is not giving what I want. He is not giving what I want. So will I pay my 10,000? I will not pay. So whenever the issuer is not giving what I want, I will not pay what he is asking. Remember, issuer gives Bn, C and N. Issuer actually decides on this. The issuer is asking Bn. I will not give Bn. That is the face value. So I will pay less than the face value. So that shopkeeper I tell, look, I want 100 channel television. You are having only 80 channel television. Therefore, you are not meeting my expectation. So where is the question of giving you 10,000? I will give you only 8,000, like that. Suppose the third shop I go, he says, sir, we have 120 channel television latest in the market. So he is giving more than what I want. So there, I would be willing to pay a premium. Okay, I will increase my budget and I will buy this television. So the concept is what the bond gives and what the investor wants. If what the investor wants and what the bond gives match, that is K equal to C. Bond will trade at par. But if the bond is giving less and the investor is expecting more, then will the investor give BN? No, he will not give. Then he will buy at discount. Remember, thinking is not so easy. Now you are responding. But after some time when I test, your answers will be reversed. Why? What we fail to understand is, we fail to understand the inverse relationship. We must remember that K is in the denominator. So when you answer, I feel you should also think mathematically. Where is K in the formula? K is down. So you think an answer, it will be very smooth. Similarly, if the bond is giving 10% and I want 8%, now you think of that formula. Bond is giving 10%, where it is there, numerator, and I want 8%, where it is. So 10 upon 8 is greater than 1. So I will pay premium. So why I am training you like that? Because when you read the problem, so you should know whether this bond will quote at premium or whatever it is. So this is a very, very important concept. So we have learned a lot of things here. Okay. And second thing is the third one. Third one is this. We will learn, more later on. What is the difference here? Minus 2%. What is the difference here? Now, what is the difference here? Minus 7.25%. What is the difference here? Plus 8.03%. Right? Plus 8.03%. Now, K is rising and falling by constant 2%. But is the price change symmetric? Asymmetric. Usually, for falling prices, when you see for falling rates, the price rise will be more. Price rise will be more. Now, we will learn much detail, but I'll give you live example. As when we used to manage our portfolio, you must be aware about SLR, statutory liquidity ratio. Banks have to maintain SLR to the extent of 25%. What they should do, they should buy government securities and they should report to RBI. Now it is not, nobody stops them from holding what is called as more, say instead of 25 you hold 27 or 28. Nobody will stop them. So some banks used to hold. So we used to monitor them. Who is holding more SLR? Why? Because when the rate changes, we are able to see when the rate falls, who is going to see larger capital gain? Who is going to see larger capital gain? So automatically it will be reflected in the EPS. So therefore we buy their shares ahead of other people. So for that purpose you must know in their portfolio, in whose bank's portfolio you have more than required government securities. Okay. So this is a very, very important thing what we have seen now. So we'll write all the three properties. First you write summary. Now you copy. Write down. From the above table, we can infer. From the above table, we can infer three properties of bond. From the above table, we can infer three properties of bond. Number one, bond price and expected rate of return. Bond price and expected rate of return, within bracket you write also called yield. Bond price and expected rate of return, within bracket you write also called yield, bracket close, are inversely proportional. Are inversely proportional. Okay, just give the name also here. A, B, and C. We gave the name, no? Three bonds. In the case of bond B, in the case of, continue writing, in the case of bond B, K was lower, K was lower as compared to bond A. K was lower as compared to bond A, and price was higher, and price was higher. Similarly, in the case of bond C, similarly, in the case of bond C, K was higher and the price was lower. In the case of bond C, K was higher and the price was lower. Property number 2. Property number 2. So this we have tried in three parts. Okay, first when K equal to C, then K greater than C, and K less than C. Consider bond A. Consider bond A. Here, expected rate of return K. Here, expected rate of return K matched bond coupon, matched bond coupon at 10%. Matched bond coupon at 10%. Such bonds where K is equal to C. Such bonds where K equal to C trade at par. K equal to C trade at par. That is B0 is equal to Bn. That is B0 is equal to Bn. So whatever will be Bn, that will be B0. Then next line you write. Consider bond B. Consider bond B. Here, expected rate of return was lower than. Here, expected rate of return was lower than what bond paid. Expected rate of return was lower than what bond paid. Within bracket, C equal to 10%. Within bracket, C equal to 10%. Therefore, when K less than C, therefore when K less than C, bond trades at premium. K less than C, bond trades at premium. Since bond is offering more than, bond trades at premium, since bond is offering more than what the investor is demanding. Bond is offering more than what the investor is demanding. Bond is offering more than what the investor is demanding. Therefore, B0 greater than Bn. Therefore, B0 greater than Bn. Such bonds are said to be trading at premium. Such bonds are said to be trading at premium. Leave in the right next line. Consider bond C. Consider bond C. Here, the expected rate of return. Here, the expected rate of return is greater than. Here, the expected rate of return is greater than what the bond is offering. Expected rate of return is greater than what the bond is offering. That is K greater than C. That is K greater than C. Since the bond is giving less than, since the bond is giving less than what the investor is demanding. Since the bond is giving less than what the investor is demanding, comma, the investor is not willing to pay even the par value. The investor is not willing to pay even the par value. Therefore, B0 less than Bn. Therefore, B0 less than Bn. Such bonds trade at discount. Such bonds trade at discount. Property number 3. here. Property number 3, we are going to write, between A and B and A and C. Write down. When yield falls, property number 3, when yield, that is expected rate of return or K, when yield within bracket K falls by 2%, when yield within bracket K falls by 2%, within bracket you write compare A and B. Within bracket you write compare A and B, bracket close. The price of the bond increase by, copy this, price of the bond increase by 8.03%. However, after this you write, however, when the yield rises by same quantum of 2%, however, when yield rises by same quantum of 2%, within bracket you write compare A and C. Within bracket you write compare A and C, bracket close. The price change is, copy from the board, sorry, minus 7.25%. Therefore, we can see that for same percentage of rise and fall in yield, therefore we can see that for same percent of rise and fall in yield, percentage change in B0 is not symmetric. Percentage change in B0 is not symmetric. In fact, for fall in yield, price change is higher. For fall in yield, price change is higher as compared to rise in yield. As compared to rise in yield. Okay, next. Example, calculate price of bond D. Calculate price of bond D. C equal to 10%. C equal to 10%. BN equal to 1000. N equal to 10 years. And K equal to 10%. Okay, write down. we are going to write something different here. See, what we are going to write is the maturity does not affect that principle that when K equal to C, bond will trade at par. We are going to write that. If you want to calculate, you can verify. You want to calculate? Tried. Okay. Write down. All my past batches calculated. Anyway, write down. I will give a sentence accordingly for you. We can easily find that B0 is equal to 1000. We can easily find that B0 equal to 1000. Write in red. We can conclude that irrespective of the maturity of the bond, we can conclude that irrespective of the maturity of the bond, comma, when K equals C, B0 will be equal to Bn. B0 will be equal to Bn, that is bond will trade at par. That is bond will trade at par.